Canada is facing an uncomfortable question that few are willing to say out loud. If the US economy stumbles, can Canada remain standing, or will it fall alongside it? Beneath seemingly dry numbers, the pulse of risk is accelerating. Interest rates remain higher for longer than expected. Yield curves grow increasingly distorted, and financial liquidity tightens quarter by quarter. The Canadian dollar swings sharply against the US dollar. Real estate cools after years of overheating, while household debt reaches historic levels. Globally, rising credit default swap premiums have often been an early warning before crises erupt. History shows recessions rarely arrive with sirens, but quietly, under a dangerous sense of confidence. Canada is not the United States, yet it does not exist outside America's economic gravity. When the world's largest engine slows, smaller gears always begin to shake first. The question is no longer if, but when and how. Economic crises rarely announce themselves all at once. Instead, they emerge as small cracks in a much larger structure. In Canada, the first crack appears in interest rates. As the central bank keeps rates elevated to control inflation, borrowing costs rise faster than incomes. The real estate market, a psychological pillar for Canadians, begins to stall, transactions decline, and prices lose momentum. Credit card delinquencies and mortgage stress quietly increase. Financial liquidity tightens as banks grow more cautious. Internationally, the Canadian dollar weakens whenever the US dollar strengthens, reflecting deep reliance on global capital flows. This pattern has appeared repeatedly before crises in Argentina, Greece, and Turkey. The most dangerous signal is not collapse, but the prolonged belief that everything is still fine. The mechanics of an economic shock begin not with panic, but with prolonged imbalance. Years of low interest rates encourage borrowing, pushing asset prices, especially real estate, far beyond fundamentals. When inflation forces central banks to reverse policy, the sudden rise in borrowing costs places immediate stress on the system. Businesses cut investment, consumers reduce spending, and money circulates more slowly. Liquidity becomes a matter of survival. Credit markets fragment, CDS spreads widen, and default risk enters the conversation. The shock spreads beyond finance into psychology, as declining confidence makes every economic decision more cautious. The IMF noted during the 1997 Asian financial crisis that the true trigger was the combination of high debt, capital flight, and collapsing confidence. Canada now stands in a sensitive phase of that same cycle. Global comparisons show that recessions never follow a single script, yet they share common themes. The US crisis of 2008 began in housing and spread through the banking system. Argentina's repeated collapses stemmed from monetary instability and sovereign debt. Greece was suffocated by soaring borrowing costs and evaporating investor trust. Turkey and Venezuela demonstrate how currency collapse fuels inflation and social strain. Canada differs through stronger financial regulation, but remains deeply dependent on US trade and global capital flows. When the US slows, exports weaken, investment retreats, and fiscal pressure rises. These global lessons are not about ranking failure, but recognizing that no economy is immune to the business cycle. The impact on Canada begins in familiar places. Small businesses feel rising borrowing costs, shrinking margins, and postponed expansion plans. The labor market cools not through mass layoffs, but through cautious hiring and reduced hours. Real estate, the primary store of wealth for the middle class, loses its psychological support. When home prices stop rising, the feeling of wealth fades and spending contracts. A weaker Canadian dollar boosts exports, but makes imports more expensive, prolonging inflation pressure. This pattern has preceded mild downturns that later deepened in many economies. Canada may not collapse, but it cannot escape prolonged turbulence. Government and central bank responses operate on a narrow ridge. Ease too early, inflation may return. Hold too long, and the real economy suffocates under tight liquidity. Fiscal support is weighed carefully after the pandemic, with public debt already elevated. The central bank watches inflation, employment, consumer credit, and financial systems CDS spreads closely. But monetary policy alone cannot fix structural stress. Greece showed that excessive austerity deepens recessions, while Argentina proved that reckless money creation destroys trust. Canada is attempting to avoid both extremes amid rising global instability. At the personal level, recession does not appear as headlines, but as subtle shifts in daily life. Mortgage payments rise by hundreds of dollars a month. Grocery bills climb while wages lag behind. Anxiety leads households to delay major purchases. Home upgrades, even family plans. This psychological channel is the most powerful transmission mechanism of crisis. When millions of individuals simultaneously choose caution, the economy slows itself. IMF research from 1997 onward shows that households with strong balance sheets recover faster. This reality is unglamorous, but brutally consistent across cycles. Survival strategies during uncertainty are not about predicting the exact moment of recession, but about adaptability. Reducing leverage, preserving liquidity, and understanding interest rate risk are fundamental steps. Diversifying income sources lowers dependence on a single cash flow. For individual investors, the goal is not fleeing markets, but understanding exposure. Which assets are sensitive to rates, currency shifts, or economic cycles? Those who endured crises in Argentina or Turkey did not succeed because they were smarter, but because they were more disciplined with risk. Every recession delivers a deeper message: repricing. Assets once considered safe suddenly reveal hidden fragility. Real estate, bonds, even cash carry different risks depending on context. Canada benefits from institutional stability. But stability is not immunity. Economic cycles move like tides, receding to expose who has been swimming without protection. Recognizing this reality prevents panic without encouraging blind optimism. Whether Canada enters a recession similar to the United States may not be the most important question. More important is how prepared society truly is if it happens. Does the government retain policy flexibility? Can businesses endure sustained pressure? Can individuals adapt? Economic history shows recessions always pass, but how we emerge determines who loses the most and who grows stronger. As cold numbers translate into real life, the final question for the viewer remains: where do you stand in this cycle?